Today, I'm going to be breaking down a topic that every single investor in Nigeria needs to know about in 2026. I'm talking about capital gains tax or CGT. So, what is capital gains tax and why is everyone talking about it? Let me break it down for you in the simplest way possible. Let's say you buy a piece of land around you for 2 million naira, and after 5 years, the area develops and you sell that same piece of land for 10 million naira. The 8 million naira profit you made from the sale of that piece of land is what we call capital gains. Capital gains tax, CGT, is what government taxes you from the 8 million naira profit you made from selling that piece of land. It is the exact same thing for shares. Say you buy shares in a company like Dangote and you sell them later for a profit. That profit you make is capital gains. And under the new law, the government will be taxing that capital gain from the sale of your shares. Now you might be asking, what asset gains exactly qualifies as chargeable gains? Well, under the new Nigerian Tax Act 2025, which is much more broader than before, almost every asset you can think of falls under this act. Shares listed on the Nigerian Stock Exchange, shares of private company, unlisted shares, landed properties and jewelries, and even digital assets such as crypto and NFT all fall under the capital gains tax in the new Nigerian Tax Act 2025. And let's be clear, this is not the same tax as the tax on your dividends. That squarely falls under income tax. Dividend tax is charged on earnings that companies pay out to you, while CGT only applies when you sell a share or an asset for a profit. So if you don't sell, you don't pay. It's that simple. So why is this happening now? I know you must be thinking, is Nigeria not stressful enough? Why another tax? Well, according to the government, they are doing this for one major reason: to broaden their tax base and reduce the country's dependency on oil revenues. What this really means is that they are targeting high value investors and institutional players who have been benefiting from market growth, and they want them now to contribute to public revenue. Now, the big question: when is this tax starting and who does it really affect? Well, for starters, it's definitely not starting tomorrow, so don't rush off to go and sell all your shares. The capital gains tax will take effect from 1st of January 2026. So technically, you still have some time to plan ahead and make one or two adjustments to your portfolio. And who will it affect? Basically, it will affect every single investor in Nigeria, but in different ways. If you are a resident investor, meaning you live here in Nigeria, you will be taxed on capital gains you made on stocks from the Nigerian Stock Exchange, and also on capital gains you make from stocks from around the world. For example, if you buy Apple shares in the United States and you sell those Apple shares for a profit, you are expected to pay CGT here in Nigeria. But if you are a non-resident investor, meaning you are a foreigner or a Nigerian living abroad, you are only expected to pay capital gains tax on Nigerian companies or stocks you bought and sold on the Nigerian Stock Exchange. Well, here's some good news. You might not even pay this tax. This is part of the video you've been waiting for, so listen carefully. You see, the Nigerian government put in place some very important rules which protects small-scale investors like you and me. There are two major exemptions, but you only need to surpass one in order to pay the tax. Firstly, if your total capital gains tax in 12 months is less than 10 million, you will not pay the tax. Let me repeat that. If the total profit you make in an entire year is 9.9 million or less, you are totally exempted from paying the tax. Secondly, if the total proceeds you get from selling all your shares within a 1 year period is less than 150 million, you are also exempted from paying the capital gains tax. Meaning, if you sell all your shares and it's less than 150 million and your profit is also less than 10 million naira, you are totally exempted from paying the tax. But if the total proceeds you get from selling all your shares in 12 months is above 150 million, but your profit is less than 10 million, sorry, you are not exempted from paying this tax. You will pay the capital gains tax. So you only need to surpass one of these rules in order to pay the capital gains tax. So for most everyday investors, you can relax. This new tax will likely not affect you. It is designed to target the high net worth investors and the big market players. I know you must be thinking, can you legally avoid or defer this tax? Now, even if you are a big investor, there is a smart incentive within this tax called Reinvestment Relief. Here is how it works. If you sell shares and make a significant profit, but use the proceeds from the sale of that share to buy another qualifying Nigerian shares, you then defer paying these taxes on the reinvested portion. This move by the government is designed to encourage keeping money in circulation within the local economy rather than people cashing out and moving their funds abroad, according to the government. While we are still waiting for the FIRS to provide full guidelines, this is a strategy you should keep in mind. But what about gifts and inheritance? This is another common question. If your parents gives you shares or you inherit a stock portfolio, will you be taxed? The simple answer is no, not when you receive them at least. The new law specifically exempts certain gifts and inheritance from being taxed as long as no money is changing hands. But here's the catch. The tax is triggered once that asset is sold, meaning you can pass on assets to your children tax-free. But once your children decide to sell that asset, bam, that's the moment they will have to pay the tax on the capital gains they have made from the sale of those shares or those assets. So now for the big boys, how is CGT even calculated? Okay, let's say you are a big investor and you know at the back of your mind that you are going to surpass the threshold we discussed about earlier in this video. How do you go about calculating your capital gains tax? It is actually straightforward. The formula is net capital gain equal to sales price minus allowable expense minus cost of acquisition. Allowable expenses here are direct cost of transaction such as brokerage fees and commissions. Let's use this example. You bought MTN shares for 5 million naira. This is your cost of acquisition. And you paid brokerage fees of 50,000 naira total for the transaction. That is your allowable expense. A year later, you sell your shares for 18 million naira. Now, this is your sale price. In this case, your capital gain will not be 13 million naira. Let me explain why. You sell your shares for 18 million, that's your sale price, minus allowable expense of 50,000 naira, minus cost of acquisition of 5 million naira. So now your net gain is equal to 12,950,000 naira because we removed the 50,000 naira transaction cost you paid to your brokers, leaving us with 12,950,000 as your net capital gain. And that is the amount that your capital gains tax will be calculated based on. So, what are the capital gains tax rates? For companies such as investment firms or a mutual fund, you pay a flat rate of 30%. But for individuals, the capital gains is added to other incomes we get within that year and is taxed as our personal income tax, PIT, which is progressive up to a maximum of 25%. So, how does the new tax rate compare to other African countries? As it is useful to have some perspective, are the Nigerian rates high? For capital gains tax in Nigeria, individuals pay up to 25%, while companies pay a flat rate of 30%. In South Africa, the effective rate for capital gains tax on individuals is 18%, while companies pay up to 21.6%. In Kenya, everyone, companies and individuals, all pay a flat rate of 15%. What about Ghana? Capital rates in Ghana are included as part of your income and are taxed on a normal rate of 15%. So, on paper, the Nigerian CGT rates are one of the highest in Africa. So, what's the real impact on the Nigerian stock market and also on you, the investor? My take is, in the short term, we might see investors rushing to sell off their shares before the January 1st, 2026 deadline in order to lock in their profits tax-free. And this move will definitely cause a dip in market prices. For long term, it might slow down trading activities in the market as people may decide to hold their shares for longer in order to avoid paying capital gains taxes frequently. Another angle is that it could reduce speculation and lead to a more stable and value-driven long-term investments. Could this new law slow down investment flows? In my opinion, yes, because the burden of tracking your sales price, your cost of acquisition, and your allowable income or the brokerage fees might be so much for active traders, which will limit their activities. Again, this might not be a problem for long-term investors who are disciplined and do not have plans of selling anytime soon. What message does this new tax law send to foreign portfolio investors? 30% for companies is just too high. This might discourage foreign portfolio investors who already face currency risk from coming into the market. But the key is the execution. So let's wait and see. So what then are the risks to you, the average retail investors? Let me be clear. The risk to you, the investors, is not in paying taxes, as a lot of retail investors will fall below the exemption lines. The real risk to retail investors is actually indirect, because if the big players, such as institutional traders and the high net worth investors, reduce their trading frequency in order to slow down their taxes, this could make the market become less liquid. Meaning, if there are fewer buyers and sellers in the market, it could get hard for you to sell your shares at the price you want them when you want them. This could lead to slower market growth and also slower portfolio growth for everyone. In my opinion, an emerging economy like that of Nigeria should be more focused on policies that will increase market activities and also invite foreign portfolio investors, and not the other way around. So, what do you need to do to prepare for the new 2026 capital gains tax? Well, as they say, knowledge is power, which you're already doing by watching this video. But preparation is everything. The new tax laws means that you can no longer be casual with your investment records, because when it's time to file your taxes, the FIRS won't take your word for it. They will need proof to be sure that you are exempted from taxes or you fall within a certain tax bracket. Keeping your investment documents safe will save you a massive headache, especially if you have to prove that your profits are below 10 million naira, so you are exempt from paying capital gains tax. Now, I would like to hear from all of you. What do you think about the new capital gains tax in Nigeria? Do you think it's a good move, or do you think it's going to discourage investors? Let me know in the comment sections below. If you learned something from this video, please hit the like button. And if you enjoy finance and investment kind of videos, kindly subscribe to my channel for weekly financial tips. To learn about investment strategies you can use to grow your money before the new capital gains tax kicks in 2026, watch the next video on your screen.